We've been taught to think that money itself is what guarantees stability, that if a currency is backed by gold, we're safe, untouchable, and protected from economic turmoil. It sounds reassuring, almost absolute, but history tells a very different story. The gold standard, once the backbone of global finance, created the illusion of stability, while quietly imposing constraints, crises, and hardships on nations, businesses, and individuals. To understand why, we need to look at the rise of the gold standard, its promises, and the harsh realities that eventually tore it down. The gold standard wasn't invented overnight. It developed slowly during the 19th century as countries sought a common, reliable measure of money. Britain, with its powerful economy, led the way. By pegging the pound to a fixed quantity of gold, the government created confidence. Money couldn't be printed at will, inflation seemed impossible, and trade became more predictable. On the surface, it appeared to be the perfect system. Governments, investors, and citizens alike trusted that gold-backed currencies could never lose value. But just like the wealth versus value trap, there was a hidden weakness. The system was only as strong as the supply of gold, and the global economy's demands often outpaced that supply. For decades, the gold standard seemed to work. International trade flourished. Nations could convert currencies into gold, and investors had faith in cross-border transactions. But this very rigidity became a problem when economies needed flexibility. In the early 20th century, the world faced shocks that the gold standard simply couldn't absorb. Countries couldn't adjust money supply to respond to recessions, unemployment, or wartime needs. When World War I erupted, nations suspended gold convertibility because they needed to print money to finance armies. Gold could not expand with the demands of modern economies, and that inflexibility came at a huge cost. The post-war period showed the danger more clearly. Britain returned to the gold standard in 1925, insisting the pound should be backed at pre-war levels. It was a symbolic move meant to restore global prestige, but the consequences were severe. Industries that had recovered from wartime disruptions suddenly found exports uncompetitive because the overvalued pound made British goods expensive abroad. Unemployment rose, social unrest grew, and the illusion of stability revealed itself as fragility. Countries were bound to gold in a way that benefited prestige but punished productivity. The gold standard created winners in theory, but in reality, it left ordinary people struggling. Across the Atlantic, the United States faced a similar dilemma. The gold standard initially helped anchor confidence in the dollar, especially after the chaos of the Civil War and the post-war banking crises. But the system limited flexibility, particularly when the Great Depression hit. Banks failed, industrial output fell, and millions were out of work. The US could not expand its money supply freely because each dollar had to be backed by gold. Deflation set in, debt burdens became crushing, and recovery was painfully slow. The gold standard, intended to ensure stability, had become a straitjacket. It wasn't wealth itself that failed. Money was still backed by gold, but the system failed to provide real economic resilience.
Countries began to abandon it. Britain left the gold standard in 1931. The United States followed in 1933 under President Franklin D. Roosevelt, ending the domestic gold standard and revaluing gold to stimulate the economy. The world had learned a crucial lesson. Tying currency strictly to gold didn't protect economies from depression, unemployment, or financial panic. It merely tied them to a fixed resource that couldn't adapt to the needs of a growing, complex economy. Flexibility and adaptability, forms of real economic value, were more important than rigid adherence to gold. Yet the allure of gold never fully disappeared. Even in modern times, it remains a store of value and a hedge against uncertainty. Investors flock to gold during crises, confident it won't evaporate like paper wealth. But the historical lesson remains. Relying on gold as a guarantee of stability without considering underlying economic strength is a mistake. Gold is only as useful as the systems and institutions that surround it. A country rich in gold but with weak institutions, mismanaged finances, or collapsing industries is not secure. It's vulnerable. The 1971 decision by President Richard Nixon to end the dollar's convertibility to gold, the so-called Nixon shock, marked the final collapse of the gold standard era. Economies were free to expand, contract, and adopt their money supply to meet real-world needs. That flexibility allowed the global economy to grow in ways that would have been impossible under strict gold rules. But it also demanded a new kind of discipline. Nations, corporations, and individuals could no longer rely on a fixed metal to protect them. They had to understand value, not just the appearance of wealth. Throughout history, those who weathered economic crises were rarely the ones hoarding gold or counting on currency alone. Survival depended on assets that generated real value: productive land, adaptable industries, transferable skills, and systems capable of enduring shocks. Nations that diversified resources, invested in human capital, and built resilient financial institutions often prospered even when currencies collapsed or reserves were depleted. The principle is timeless. Real stability comes from underlying value, not fixed numbers, certificates, or precious metals. Even today, traces of gold standard thinking shape financial behavior. Central banks maintain reserves, investors often view gold as a safe haven, and governments emphasize fiscal discipline as a measure of stability. These approaches provide comfort, but history demonstrates their limits. Paper wealth, currency, or even gold can quickly lose effectiveness if confidence erodes or economic conditions change. Relying solely on symbols of stability without fostering adaptability leaves nations, institutions, and individuals exposed to unexpected crises. The modern lesson mirrors these historical patterns. Financial resilience is built on assets and skills that retain usefulness across circumstances. Land that produces food, industries that adapt to changing markets, and knowledge that remains in demand can sustain value even when systems falter. Likewise, institutions and governments that prioritize flexibility, strong governance, and diversified portfolios are far better positioned to withstand shocks than those that depend only on appearances of stability.
Understanding the difference between rigid structures and real economic strength is essential. Wealth is more than a number, and security is more than a balance sheet. By focusing on enduring value, both individuals and nations can navigate uncertainty with greater confidence, adapting to change rather than being undone by it. True financial durability arises not from symbols of stability, but from systems, assets, and skills built to survive and thrive through economic turbulence. So, what does this mean for you today? Whether you're investing, saving, or planning for the future, the gold standard teaches us that security is not about what backs your money, but what supports your economy. Assets with tangible utility, skills that remain in demand, and resources that people need will survive shocks far better than paper promises or fixed metallic standards. History isn't just a story. It's a guide for building resilience in your personal finances and decisions. The rise and fall of gold standard economies is a reminder that no system, however revered, guarantees safety by itself. Real security comes from understanding value, creating durable assets, and cultivating skills and resources that endure beyond the fluctuations of money, markets, and metals. Gold can hold value, but only if it exists within a system capable of using it effectively. The same principle applies whether you're managing a nation's economy or your own finances. History has shown that chasing appearances, whether it's gold, stock prices, or prestige, without understanding underlying value leads to disaster. Countries tied themselves to gold expecting permanence, yet when the system broke, the consequences were immediate and painful. Those who invested in real assets, diversified their resources, and focused on utility survived, while others were left scrambling. The takeaway is clear. Focus on building real value, not just relying on what looks secure. That's the lesson from centuries of gold standard experiments and collapses. It's not about the metal itself. It's about resilience, adaptability, and practical utility. If this insight gave you a better understanding of how financial systems really work, hit subscribe. We explore history, money, and value so you can see through the illusions and make smarter decisions that last.